Good afternoon, everyone, and welcome to the weekly precious metals and commodities commentary. My name is Jeffrey Halley, and I'm a senior market analyst here at Oanda, Asia Pacific, here in Singapore. Let's just crack straight into everything and have a look at gold initially. The last few days, well, last Friday, in fact, we finally saw this 1296 region, this giant double top broken as the dollar fell and ahead of the weekend. We saw gold actually, let's just widen that out a little bit. We saw gold spike to 1301. The price action itself, I feel, was probably driven more by stop losses once this 1296 broke. This happened much later in the Friday session in New York in a period of low liquidity. I would think that there would have been stop losses above 1296 and also most likely some option structures, particularly knockouts around the 1300 area. The price action itself was very much a quick spike up to 1301 and then an immediate drop back down towards the sort of 1285 area. Which is always suspicious when it happens late on a Friday, to be honest, in New York. In fact, we came very, very close to tracing an outside reversal day here, but that didn't occur. Just looking at the chart though, we seem to have consolidated over the last couple of days, and we do seem to be in a bit of a holding pattern now ahead of Jackson Hole, which the symposium of all the great in the central bank world, and also economists and any other sort of named faces in the financial markets all get together in Jackson Hole and talk about wonderful things for a few days. Most interesting is the keynote speakers, in this case Mario Draghi, the head of the ECB, I believe is on Thursday, and then on Friday it will be Fed Governor Janet Yellen, and the market will be hanging off every word she says, looking for insight into the direction of the Fed's thinking on interest rates. A hawkish testimony may see some US dollar strength actually, and given that the world is so universally bearish on US dollars at the moment, this could actually lead to a short-term retreat in gold as the dollar strengthens. Nevertheless, the chart itself is still very constructive. Although we've broken through this 1296, we haven't actually kept on falling back towards this trendline support. We do seem to be consolidating, and I do rather suspect that into this week we'll see a lot of markets just sitting there in a holding pattern waiting for Mrs. Yellen to speak later in the week at Jackson Hole. In the meantime, if we get back to reality, we have this trendline support, which is pretty much held since the beginning of July. We had one little nibble down here in early August, but it actually didn't close below it, and this is where it also crossed the 100-day moving average. Since then, it's held every single retreat, this trend line. This comes in at around 1277 today, and this line, I think, as long as we hold this line, the bullish pattern in gold, which is very much seems to be like an up channel, remains intact. Bear in mind also that the geopolitical tensions that we are seeing and the turmoil we have coming out of Capitol Hill and the White House are probably not going to go away anytime soon either, and this should also be constructive for gold. If we get through this trend line, the next target will be down and around this 100-day moving average, which today is around 1256.60. Perhaps the only thing we need to keep an eye on if we drop down to the bottom of the chart is the RSI, which has been bubbling along at elevated levels for a while now, but it's still not in heavily overbought territory. So on that basis, I think the charts are still pointing towards a higher resolution in gold, but we are probably going to have to wait until the end of the week in that speech to see what happens next. Let's rock over to silver. Price action here is really just not following gold, and it is slightly disappointing to be honest. It seems to be very much a sideways consolidation, pivoting around this 100 and 200 day moving averages, which are buried amongst all these bars here. And we can see the lower level here, 1683.70, and the 17.2540 seem to be holding for the vast majority of time, with the exception of this little spike here, the range. This longer term support line, which is now resistance and comes in around, let's just extend this bad boy out a little bit, sorry. Comes in today at around 1805 and becomes resistance. Once it broke this, it just seems to be consolidating sideways. This 1683.70 line really does need to hold now with silver, and a break of this line would target a move down to the 1658 region. This next low from mid-August. I can't really explain, to be honest, why silver hasn't found the love that gold has found over the last couple of months. I would perhaps put it down to perhaps illiquidity and this whipsaw price action here, which has burnt traders this year. And I suspect that maybe silver is just really off the radar with traders at the moment, and they would prefer to hold their risk in the much more liquid gold contract. Having said that, that could mean that at some stage silver does play a large catch-up very quickly with gold, but I don't think there's anything here in the chart pattern suggesting that for now. Let's go to our friend platinum. The most important thing I want to point out to you here is this blue line, which is sitting in the middle of the chart, and the spike down in platinum held this 200-day moving average exactly. This means, from a technical perspective, that this is now quite important pivotal support in platinum. We can see the support line here at 968.30. I think that one's a little bit marginal now, seeing as we've been down and through. The next resistance above is this daily high here from early August, which still continues to be around 992.20. Now this chart itself is also perhaps slightly underwhelming to look at it, but I think to get a proper perspective on platinum, we need to go to the weekly chart, and there the perspective changes quite noticeably on platinum. So let's just jiggle this around a bit to fill in this blue line here. When we look at this chart, we are actually seeing platinum breaking out of a long-term resistance and also breaking out of a long-term wedge shape here, with this must-hold support down here around 889.40. We are an awfully long way away from that right now, and even this 968 line starts to make a little more sense at this point on the weekly chart, because it actually coincides with the 100-week moving average, which is around the same level, within about 100 points, which is close enough for government work, 967.70. So this chart here actually looks reasonably bullish, and I think with platinum, again, it's lagging the move up in gold, but when you look at it from a longer term perspective, the price action and the breakout of this downward moving wedge is actually potentially quite bullish from a technical perspective, and the next bigger target on the weekly basis would be somewhere around 1045. So perhaps if you're a platinum bug, you need to be a little patient. Let's pop back onto the dailies again. Head over to Palladium. I call Palladium the metal that just keeps on giving, and this chart today is no exception to that one. I'm just move this thing out to fill in some of the lines here. We can see this long-term support line that we've seen well for the last year is still completely intact. We're still an awfully long way away from a retrace there. More importantly, on the top side here, this 917.95, 918 level broke over the last week. Even more constructively than that, we are actually consolidating above this 918 level now. So we've gone and broken it, and now we're consolidating above this level. We are in uncharted territory here with our Palladium. Remember, as I've said in previous times, it does have a dual industrial use. So palladium tends to move to its own beat with that dual precious metal industrial usage in the price action. What can we say about this? Well, now 918 becomes a pivot level and support. As I said, we're in uncharted territory to the top side, but we are consolidating nicely above that level. Bear in mind that zinc and copper, particularly zinc, have had pretty spectacular weeks as well. And with that industrial metal complex all moving higher, that would potentially be positive for platinum as well. Way down below, support-wise, we have the 100-day moving average at 842-ish. This long-term support line sitting around the 814 level, perhaps a little bit higher now, and then the 200-day moving average around 795.60. So we actually do have a lot of longer-term support down here, along with this 828.40. So I guess from the chart itself, you could say that we're still a long way from supports, and actually to turn bearish on palladium we would probably have to be looking down through the 200-day moving average, to be honest, right now. So as I said before, it just seems to be the metal that keeps on giving. Let's pop over to copper, which I've immediately messed up, of course. Here we go. Again, a fairly constructive looking chart, to be honest here. Let's just move this over and drag this line out a little higher. We seem to have moved. We've had a sort of a false test, if you like, of this longer term support line. Now, it does actually seem to coincide roughly with this longer term or medium term horizontal line, which is around 286. I guess what we can say from this is that we've been down to this longer term support line and around this 286 support area, and we've held that, and now we've moved higher and we've consolidated. More importantly, what we've done is broken through this other long-term resistance line, which is around 296.50. If we zoom out on copper, perhaps we'll get a better idea here of what I'm talking about. This resistance line goes back a long way, all the way back to around these multiple tops in the first half of 2015. And I think it can be quite significant that we've actually broken out of those now, which would initially target this level here around 3.12. But as long as we continue to consolidate above this line, I think now that we have the potential for another technical move higher, and indeed copper's uptrend would most likely not be in trouble, I feel now, until we see this previous support here at 286 broken, and we have a close there on a daily basis. While I'm talking a lot of gas, I guess it's a good time to go and have a look at natural gas. And again, we seem to be flirting with this long-term support line here in natural gas. And let me just squash this up and show you just how far back again it goes, just so you get a better picture. And this goes all the way back to early 2016. So natural gas in this ascending wedge shape seems to be sort of teasing us at the moment and fairly directionless. It's a little hard to draw a strong conclusion here. Clearly we have this resistance around 3.0960. We have the 200-day and the 100-day moving averages just ahead of that at 303.40 and 307.35. We have this long-term support, which is today coming in around what is that saying there? 291.30. Is it still a valid line? A little hard to say now, to be honest, yeah. I mean, it is a long-term support line. I think we need to monitor more closely. This 253.20 is perhaps more important to watch out for. What I'm also watching here at the moment, readers, is actually whether we're developing into a head and shoulders top. Now, I've shown you this before, potential shoulder, head, potential shoulder. If I pop over here to the weekly chart, we can see this a lot more clearly in my mind here. Also, we can see a lot more clearly this longer term support line. We can also see that the 200-week moving average comes in just above this 309.60 resistance. But if we can just visualize here, shoulder, head, shoulder, a negative formation. I'm pondering where we would draw the neckline on this, my inclination, and I'm happy to be corrected by better technicians than myself. Comes into me around this 237.60. Now this would imply, if we had a daily close below it and we move straight down from here, a move from the top of the head to the neckline, and that would take us somewhere down below this low here around 157. That could be quite emotional, I think, for the energy markets, but it's still a little too soon, I feel, to confirm this, but it's certainly something that I think I should bring to viewers' attention. Let's pop over to Brent crude now. Brent is actually performing better than WTI. And the most important thing to think about with Brent crude at the moment, I feel, let's just get rid of that Fibonacci that's on a diet. The most important thing I think to look at with Brent at the moment, as we move to the daily, I thought that didn't look quite right. Much better. Okay, squash this bad boy up. Okay, and we move this down. There, much better. This is the story I wanted to tell. The Brent oil futures are moving into a situation called backwardation, and that's where the spot contract is a higher price than the forward delivery contracts. What does this mean? This is actually a bullish structure in the oil market, and the reason for that is because it means that participants in the oil market have a much higher urgency to secure supplies of spot oil for immediate delivery, which of course means that the price of spot oil for immediate delivery moves higher. When a market is in contango, which is where the curve goes from the bottom left to the top right as opposed to vice versa, that's a bearish setup. Because it means that there is no urgency within the oil market to secure immediate delivery supplies. For the first time in many years now, Brent crude, not WTI, but Brent, has been moving into a situation of either flat or small backwardation. This could possibly be signaling a turn in the oil market for Brent anyway. Yeah. From a structural point of view. Probably too soon to say that just yet, but it's certainly something that viewers should be keeping an eye on. And this also explains why the premium of Brent over WTI has moved out quite a lot higher, with WTI futures still solidly in contango. But after all the noise in the Brent crude market over the last week and a half, and let's face it, it has been pretty emotionally choppy, we do appear to still be sitting in roughly a consolidation range. And these levels that you need to watch in Brent are at 49.7 and 52.7. I just can't quite draw that accurately there, but if we can just strip out all the noise after the last couple of weeks and all the ups and downs and OPEC announcements or not, geopolitical tension, stronger, weaker dollars, massive drawdowns in the crude inventories, etc., etc. After all the dust settles, we are still consolidating in a 49.70, 52.70 range in Brent, albeit perhaps for now towards the higher end of that range. We will need to see a few days of daily closes above that level before you'll start waking me up anyway, as far as a possible move higher goes. Popping over to WTI, and we'll just get rid of this Fibonacci. As we can see here, the picture isn't quite as glamorous. We're definitely not consolidating in a range here, although we have been making a lot of noise in this 47.20, 50.25, 50.30 range. we do seem to be tracking towards the lower end of it, and we can see actually we have had a few breaks through it. So I'm somewhat dubious now about the validity of this line. We are just doing some work this morning just underneath the 100-day moving average, which is today is sitting around 47.75. And then again, we have a double top now. We had a spike in the futures, and this happened in Brent as well on Friday night, where Brent and WTI raced up in the last hour of trading in New York by some 3.5%. I'm always a little bit dodgy when you see price action like that at the very, very end of the session of the week in the last hour of New York. It's usually stop loss driven, flow driven, and it's usually done on very thin liquidity. When you see moves, big moves happen on thin liquidity, typically you'll see a retracement of those moves the following day. This has definitely happened on Monday, where basically the streets walked in after their weekend and sold oil down. Having said that, we have actually posted a small gain today. So it's down, but it's not out. But certainly I would say that the picture on WTI isn't quite as glamorous as it is on Brent at the moment. Time to go over to some of the softs now. Asked my neighbour to lend me some sugar. And this very sort of like blank looking chart probably sums up sugar at the moment. I guess what's been driving sugar this last 7 days has been its price in Brazil. It has been getting some support over the last few days as Brazilian producers start looking at using sugar to make ethanol instead of corn and wheat. I don't know the exact mechanics of this, but this does tend to they use a lot of ethanol, even for powering cars and things in Brazil. And so when Brazilian producers of ethanol flip from different sources to derive it, then that can actually drive prices. And in this case, we have seen sugar rallying, although it does have the look of a dead cat bounce right now, just off this long-term support, which must hold at 12.50 a pound. The next resistance above will be around this 100-day moving average, which is sitting today, I see there, around 14.70 a pound. I guess one of the other things that traders should note is the commitment of traders report that came out yesterday, and which is in fact backward looking by 6 days, but closely followed, did show record speculative shorts from hedge funds in sugar futures. Not to be cynical towards hedge funds, but usually when positions get crowded, they do become vulnerable to squeezes, either up or down, depending on whether the participants are record long or record short. And this may also have given some short-term support towards sugar. Let's head over to corn. Again, been on its knees over the last few weeks as report after report comes out saying that there's going to be better harvests around the world. Iowa is what stuck the knife into corn this week. Better rainfall in Iowa and new assessments of a much bigger harvest in Russia have led to corn breaking through this longer term support region at 349.20. This was a fairly key level. If we were to wind out corn, we can see it goes back quite a long way to this previous low in April. Iowa is the largest corn growing region of the United States apparently, and when it rains they can produce more corn. Quid pro quo, down goes the price. Russia is one of the largest corn and wheat producers in the world, and quid pro quo, when assessments of the harvest are marked up dramatically as they were over the week, down goes the price of corn. We are now consolidating below this long-term resistance level at 349.20. Above here, I think we need to note the 200-day moving average in blue. The reason we need to note it is because when it fell after that shock from the previous week on the USDA report I talked about previously, last week's video, the rally held this 200-day moving average exactly. So this 200-day moving average is basically sitting at 3.6 today, and this is the key longer-term resistance for corn right now. If we squash this chart out a bit more, I have marked down the next target, so to speak, in corn. Now that we've broken this 349.20 from a technical perspective, comes in around 337.60, which are these previous lows. There's about three days of them over here in December of last year. So again, things aren't looking so great from a technical picture in corn. Although I do note that perhaps the RSI is getting a little oversold, and there are quite a lot of unwinds of long positions happening on the futures exchanges as well. When that flips into a stronger short, excuse me, maybe then we may see some respite, but I think we're a way away from that yet. Soybeans. Have actually had a slightly better week than some of the other softs. Apparently dragged higher by canola. Canola bean prices have been dragged higher due to deteriorating outlooks in the harvests from Canada and Australia. I guess soybeans are used as a substitute for canola, and thus a higher price in canola means that producers are more inclined to use soybeans instead, which has meant this long-term, this support region around 922.90. Although we broke it earlier in the week, we've actually flipped back above it at the end of last week, and we seem to be consolidating above it. I don't know if this chart here really suggests that soybeans are out of the woods yet, to be honest. This 922.90 now becomes a daily pivot, with resistance now around this previous double bottom, around 947.80, and of course the 100-day moving average, which is sitting around 950.50. So this little region up here will be important resistance, as indeed will these previous two highs here, which are sitting around 9.40. Down the bottom, underneath here, this previous daily low, which is around 914.80, will be the next support, and the must-hold support for the whole longer-term consolidation pattern for soybeans is this 896.60 level, and we can see this line here. Once it's not been down back towards it for a very long time. We have a couple of lows around the same area as way back in last year, and a break of here from a technical perspective would mean that we could potentially see a move lower down to the 850 region. Let's wrap it all up now. Let's move over to wheat. Again, we can blame those pesky Russians if that's your point of view. The upgraded harvest forecast from Russia for wheat as well as corn has seen wheat itself remain under pressure over the course of the week. If I just zoom in, and really this chart isn't suggesting a heck of a lot of good news. Series of lower highs, and it's a fairly consistent downtrend. I can't really say to you that for sure that we're going to go lower from here, but the chart itself is certainly suggesting there's not too much good news there, particularly if we are now looking at a higher Russia and European harvest, which was also upgraded over the last few days, coming on the back of the USDA saying that there would be a much better harvest this year in the United States. Support continues to be this 393.70 a bushel level. This is must-hold support for wheat from a technical perspective. Up above, we'll see resistance initially around the 200-day moving average, and then the 100-day moving average, which is at 440.65, the 200-day moving average being around the 424 level. We will need, I think, some fairly major news to snap the wheat setup out of its lethargy. Having said that, in the short term, the RSI, if we look to the bottom of the chart, is at extremely oversold levels. So there may be the chance of a pullback to correct that. But again, wheat has a lot of wood to chop, so to speak, in order to regain a bullish outlook. And from a technical perspective, I think we would need to see a number of closes above this 200-day moving average here. Well, that rounds it all up for another week, ladies and gentlemen. I hope you've found this informative, and I wish you good luck and good trading for the remainder of the week. Thank you.